Let me begin with a development that may sound dramatic, but is deeply rooted in economic logic rather than political theater. When two of the world's largest geopolitical powers reduce their exposure to U.S. Treasuries by hundreds of billions of dollars and simultaneously increase gold reserves, this is not a symbolic gesture. It is a signal about confidence, about risk, and about how the global monetary system is quietly changing beneath the surface. For decades, U.S. Treasuries have functioned as the backbone of the global financial system. They were viewed as risk-free, liquid, and universally accepted. China and Russia were not marginal participants in this system. They were among its largest holders. The first hook is this: when major stakeholders reduce their holdings, it suggests not short-term disagreement, but long-term reassessment. Treasuries are no longer being evaluated purely on yield, but on geopolitical exposure and currency risk. The motivation behind this shift lies in sanctions, financial weaponization, and debt expansion. Holding treasuries ties reserves to a system where access can be restricted and value diluted through inflation. Gold, by contrast, carries no counterparty risk. It cannot be frozen, sanctioned, or printed. The second hook emerges here. This is not about chasing higher returns. It is about reducing vulnerability. Gold becomes insurance against a financial system increasingly used as a policy tool. This move also reflects concerns about U.S. fiscal sustainability. Persistent deficits, rising interest costs, and expanding debt issuance raise questions about long-term purchasing power. While treasuries remain liquid, their real value is increasingly eroded by inflation. For reserve managers, nominal safety is no longer sufficient. What matters is real preservation of value over time. China and Russia are not acting in isolation. Other central banks, particularly in emerging markets, have steadily increased gold purchases while diversifying away from dollar-denominated assets. This trend does not imply the immediate collapse of the dollar, but it does signal gradual fragmentation. The global system is shifting from concentration toward diversification, and that transition is rarely smooth. Another hook lies in market impact. Large-scale treasury selling puts upward pressure on yields, increasing borrowing costs for governments and corporations. At the same time, sustained gold buying tightens physical supply, supporting higher price floors. These are slow, moving forces, but they are cumulative. Over time, they reshape asset pricing and investor behavior. What we are witnessing is not a sudden rejection of the existing system, but a strategic recalibration. China and Russia are positioning for a world where monetary trust is less centralized and financial power is more contested. Gold, once dismissed as a relic, re-emerges not as a speculative asset, but as a statement of sovereignty. And when that statement is made at this scale, it deserves close attention. Not for what it says about today, but for what it implies about the future of global finance. Reserve allocation decisions are increasingly shaped by geopolitical risk rather than purely financial considerations. The reduction of U.S. Treasury holdings by China and Russia reflects a strategic reassessment of risk rather than a reaction to short-term market conditions. The first hook is this: treasuries are no longer evaluated solely as financial instruments, but as geopolitical assets. When reserves are held in another country's currency, they are implicitly subject to that country's legal, political, and strategic decisions. For nations seeking greater autonomy, that exposure has become increasingly uncomfortable. For decades, holding treasuries offered unmatched liquidity and stability. They were the default reserve asset not because of yield, but because of trust in the system that issued them. That trust, however, has been gradually tested. Financial sanctions, asset freezes, and restrictions on cross-border payments have demonstrated that access to dollar-based assets can be conditional. Once that reality is acknowledged, reserve management shifts from optimization toward protection. Here is the second hook. Risk is no longer measured only in volatility or default probability, but in control. Even a low-yielding, stable asset becomes risky if it can be rendered inaccessible. For China and Russia, reducing treasury exposure is a way to lower dependence on a system where financial infrastructure is increasingly used as a tool of statcraft. This is not a rejection of global finance, but a recalibration of vulnerability. Currency dilution also plays a role. Persistent U.S. deficits financed through debt issuance and monetary expansion raise concerns about long-term purchasing power. While treasuries may be repaid in nominal terms, their real value is steadily eroded by inflation. For reserve holders tasked with preserving national wealth, nominal safety is insufficient. What matters is real Long-term preservation under a range of scenarios. Another hook lies in scale. When diversification occurs incrementally, markets absorb it quietly. When it occurs at sovereign scale, it signals a shift in perception. China and Russia are not trading tactically, they are reallocating structurally. Such moves are typically slow, deliberate, and informed by long-term strategic planning rather than market timing. This de-risking process also reflects anticipation rather than reaction. Reserve managers adjust before constraints become binding, not after. By reducing Treasury exposure while liquidity remains high, these countries preserve flexibility. Waiting until stress emerges would narrow options and increase costs. What emerges from this behavior is a broader lesson about the evolving nature of financial risk. In a world where monetary systems intersect with geopolitical objectives, safety is no longer defined purely by credit ratings or market depth. It is defined by independence, accessibility, and resilience under pressure. Gold's renewed role in sovereign reserve strategy reflects a fundamental reassessment of what safety means in the modern financial system. The first hook is this: gold is not being chosen because it promises growth, but because it promises independence. In an era where financial assets are increasingly embedded within political and legal frameworks, gold stands apart as one of the few reserve assets that exists outside institutional control. Unlike bonds or currencies, gold carries no counterparty risk. It is not issued by a government, does not rely on the solvency of an institution, and cannot be devalued by policy decree. For central banks, this neutrality is no longer theoretical. Recent history has demonstrated that access to foreign, held reserves can be restricted, frozen, or repurposed as leverage. Gold, stored domestically or in trusted custody, eliminates that vulnerability entirely. Here is the second hook: gold's value does not depend on trust in governance, but on universal acceptance. While fiat currencies derive their strength from political stability and fiscal discipline, gold derives its strength from permanence. It has served as a reserve across empires, systems, and monetary regimes. In periods of transition, when the future architecture of finance becomes uncertain, that permanence gains relevance. Currency dilution further reinforces gold's appeal. Persistent deficits, aggressive monetary expansion, and rising debt burdens erode the real value of fiat reserves over time. Even when inflation is moderate, its cumulative effect is significant. Gold, by contrast, cannot be expanded to meet fiscal needs. Its scarcity is structural, not managed. For reserve managers focused on long-term preservation rather than short-term yield, this distinction is decisive. Another hook lies in diversification logic. Holding reserves heavily concentrated in a single currency exposes nations to policy decisions beyond their control. Gold introduces balance. It does not replace currencies, but it anchors portfolios against systemic shifts. As global trade becomes more fragmented and financial alliances less predictable, neutral assets grow in strategic importance. Gold also offers signaling power. Central banks rarely communicate intentions openly, but actions speak clearly. When gold holdings rise, it reflects cautious realism rather than alarm. These purchases are methodical, price-insensitive, and long-term in nature. They reshape demand quietly, tightening supply without triggering volatility. In this context, gold's re-emergence is not nostalgic, it is adaptive. As the global financial system evolves from one of centralized trust to contested credibility, gold functions less as a relic and more as a stabilizer. Its value lies not in outperforming markets, but in enduring when systems are questioned. Concerns about U.S. fiscal sustainability have moved from abstract warnings to concrete calculations, and that shift is the first hook worth recognizing. For reserve holders, the issue is no longer whether the United States will meet its obligations in nominal terms, but what those obligations will be worth in real terms when they are met. Debt that can be repaid only through continued issuance and monetary accommodation carries a different kind of risk, one that traditional credit metrics fail to capture. The scale of U.S. deficits has altered the arithmetic of confidence. Annual borrowing is no longer countercyclical or exceptional, it is structural. Interest payments consume a growing share of federal revenue, creating a feedback loop in which new debt is issued partly to service existing debt. This dynamic matters to foreign holders of treasuries because it limits future policy flexibility. When fiscal space narrows, monetary policy becomes subordinate to debt management and currency value absorbs the adjustment. Here is the second hook. Treasuries can be safe and still be unattractive. Safety in nominal terms does not guarantee preservation of purchasing power. Persistent inflation, even at moderate levels, compounds over time, quietly eroding the real value of long-duration bonds. For sovereign reserve managers tasked with protecting national wealth across decades, this erosion is not theoretical. It is measurable, cumulative, and increasingly difficult to ignore. Rising issuance also affects market structure. As supply expands to finance deficits, yields must rise to attract buyers, unless central banks intervene. Higher yields increase interest costs, reinforcing fiscal strain. Lower yields, achieved through intervention, dilute currency value. Either path places pressure on real returns. This is the dilemma that reserve managers observe closely, not as market participants, but as stewards of long-term stability. Another hook lies in credibility asymmetry. The U.S. benefits from reserve currency status, but that status rests on confidence in fiscal discipline over time. When political polarization complicates budgetary consensus and long-term consolidation remains elusive, credibility weakens incrementally. Reserve diversification becomes a rational response to uncertainty, not a judgment of imminent failure. This reassessment does not imply abandonment. Treasuries remain liquid, deep, and central to global finance. But reserve allocation is about marginal decisions. Even small shifts reflect changing perceptions. When large holders reduce exposure at the margin, it signals recalibration rather than crisis. What emerges is a nuanced but powerful shift in reserve logic. The question is no longer whether U.S. debt is repayable, but whether holding it aligns with long-term purchasing power preservation in a world of sustained deficits, rising interest burdens, and constrained policy choices. That question alone is enough to change behavior. The global reserve system is undergoing a gradual but consequential transformation, and the first hook is this: fragmentation does not arrive with collapse, it arrives with choice. When nations begin to diversify reserves, not out of crisis, but out of prudence, the architecture of global finance starts to shift quietly. The move away from heavy dollar concentration reflects a reassessment of dependency rather than a rejection of existing systems. For decades, reserve management prioritized efficiency and scale. Holding dollars in dollar-denominated assets simplified trade settlement, reduced transaction costs, and aligned countries with the dominant financial infrastructure. That concentration was rational in a world defined by relative stability and predictable rules. Today, the environment is different. Financial systems are increasingly shaped by geopolitical alignment, regulatory reach, and policy conditionality. In such a world, concentration becomes exposure. Here is the second hook: diversification is no longer about return optimization, but about sovereignty. When reserves are overly concentrated in a single currency, policy decisions made elsewhere can have direct consequences at home. Interest rate shifts, sanctions regimes, and regulatory actions transmit instantly through reserve portfolios. By diversifying into multiple currencies, gold, and alternative assets, nations reduce the risk that external decisions dictate domestic outcomes. Fragmentation does not mean abandonment of the dollar system. It means dilution of dominance. Trade settlements increasingly use regional currencies, bilateral agreements, and non-dollar clearing mechanisms. These arrangements do not replace the global system overnight, but they reduce reliance incrementally. Each marginal shift reinforces the logic of the next, creating momentum without confrontation. Another hook lies in resilience. A fragmented reserve system absorbs shocks differently. Instead of stress concentrating in one currency or market, it disperses across assets. While this reduces single-point failure risk, it introduces complexity and volatility. Exchange rates fluctuate more, capital flows become less predictable, and coordination becomes harder. Stability gives way to adaptability. Institutional behavior reflects this reality. Central banks are expanding reserve frameworks, not shrinking them. Gold holdings rise alongside regional currency exposure. Liquidity is balanced against independence. These are not ideological moves, they are risk management decisions shaped by experience. Fragmentation also changes market psychology. When no single asset is universally trusted, risk premiums rise. Investors demand compensation for uncertainty, pushing yields higher and valuations lower. This recalibration affects borrowing costs globally and reshapes capital allocation. What emerges is a world where the reserve system is less centralized, less predictable, and more politically informed. The transition is slow, technical, and often invisible to the public. Yet its implications are profound, redefining how trust, power, and stability are distributed across the global financial landscape. What we are witnessing is not a sudden rejection of the existing system, but a strategic recalibration. China and Russia are positioning for a world where monetary trust is less centralized and financial power is more contested. Gold, once dismissed as a relic, emerges not as a speculative asset, but as a statement of sovereignty. And when that statement is made at this scale, it deserves close attention. Not for what it says about today, but for what it implies about the future of global finance.